This is part 3 of our Chapter 11 video lecture, where we're going to be looking at the tax forms and schedules and worksheets to report capital gains and losses. So we're all familiar with this Form 1040 form we've been preparing throughout the semester. And we know the common types of income like wages, interest, dividends, retirement income. We basically learned that back in chapter number 3. But here in chapter 11, another type of income is capital gains, or we can subtract out capital losses. So we're going to combine all of that together. Remember, we called that in the previous video netting gains and losses. And that's done on this Schedule D. So we're going to come up with one figure here in line 6 to put in the total capital gains, be it short or long term, after subtracting out capital losses. But if you end up with more capital losses than capital gains, in other words, a net capital loss, if you remember in the previous video, we can deduct up to $3,000 of a loss here. If you have more, the excess would be carried over to next year to offset next year's capital gains and losses. So this $3,000 loss can be used to offset this other income up here. And of course, we total down to the bottom to get our taxable income. Yeah, taxable income that we typically would look up on the tax table or use the tax rate schedule to get the tax for the year. But we had gone through some examples in the previous video where this gain here, if it's a net capital gain, meaning it's a long term, after subtracting out capital losses, it gets taxed either at a 0 or 15 or 20% rate, versus the rest of the taxable income could be taxed at a marginal rate that's higher than those three rates. So we'll see where that calculation is done on the tax forms, on the tax return. But let's go back to this Schedule D where we're going to plug in just one figure over here in line 6. So here's our Schedule D that's going to be attached to your 1040 form. The title is Capital Gains and Losses, but this is just an intermediary form where numbers are flowing into this form from someplace else. But let's take a look at the different parts here of this Schedule D. In Part 1, we're looking at a summary of short-term gains and losses. Remember, short-term means that the item that you sold was owned by the taxpayers for 1 year or less. Again, if you own it for exactly 1 year and then you sell it, it's short-term gain or loss. Part 2 deals, of course, with the long-term items. And that means the item was held for more than 1 year before it was sold. Now, numbers on this form, a lot of them are coming from this other form called 8949. And you can see 3 different situations here for Part 1. There's A, B, C. And then there's a mirror image here in the long-term section. Again, numbers coming from Form 8941, but this time labeled D, E, and F. These letters here all depend upon how information was reported to the IRS. Not to the taxpayer, but to the IRS. So information that's reported to the IRS is typically this proceeds, that's the sales amount. Probably it's also the amount realized by subtracting out already the selling expenses. And then another thing that can be reported to the IRS and the taxpayer is the cost basis. Of course, sales price minus cost basis equals the gain or the loss. And if there is no adjustments to be made to that cost basis or to the profit, like a wash sale adjustment or an exclusion for sale of your personal residence, then all we need to do is add up all the sales proceeds reported to the IRS, add up all the costs that was reported to the IRS, and just plug the totals here for short term and for long term. And you can forget about the other blanks here probably on this Schedule D. But if there is no reporting of the costs, which could be common for older held investments, and if there were adjustments made to the cost basis or to the gain or loss, then you cannot use this line 1A. You got to use these other lines over here. And you cannot use this line 8A, which is just a simple reporting. Yeah, you got to use the more detailed reporting. Again, the typical situation is where the cost basis is not reported to the IRS, or there's some type of adjustment to be made. Then you got to start using the ABC and the DEF boxes. So let's take a look at this form 8949 called the sale or other disposition of capital assets. And this front page is for short-term items. And the backside would be long-term. And here's those letters again. Yeah, ABC for short-term, and in the back would be DEF. So in the case of situation A, is where Form 1099-B that was issued by the broker and a copy goes to the IRS shows everything, shows the sales price, shows the basis costs. So what we would do is write in the detailed transaction describing what was sold, the date the taxpayer bought it, the date the taxpayer sold it, the sales price, probably minusing out the selling expenses, and the cost basis that was reported to the IRS. And then probably for this situation A, there's not going to be any adjustment to come out to the gain or loss. Yeah, again, that would be the sales price minus the cost equals the gain or the loss. If I check off this, I'm going to write it in. If I check off this A box here, only A type transactions can be put on this one sheet going all the way down to the total at the bottom. Now, if I check off B, I cannot use A for this page here, but only B type transactions where the cost basis wasn't reported to the IRS. Of course, it's going to be reported to the taxpayer so they know what to put here in the cost column. But the cost basis is not required for certain types of property to be reported to the IRS. I believe it was probably stuff that was purchased maybe 8-10 years ago by the taxpayer. Those types of items, the cost basis are not required to be reported to the IRS. More recent items purchased by the taxpayer, the cost basis is required to be reported to the IRS by the broker. Okay, so again, you can check off one of these boxes over here. Only that type of transaction can be reported on this whole page. So if you need another type of transaction, you got to use another sheet like this. And if you check off C here, that means the transaction wasn't reported at all to the IRS. Okay, so that means no 1099-B was issued by the broker. Okay, and then a separate sheet would have to be entered here. So you enter each transaction for that type, and then you take a total at the bottom. And it's these totals here at the bottom that are now reported back on Schedule D in the proper ABC or DEF row. Let's take a look at the backside. Again, the backside is just for long-term sales. And again, if you check off this box D, that means the sales price and the cost basis was reported to the IRS. If you check off E, items on this page would show the sales price but no basis to going to the IRS. Although you still claim the cost basis, right, to deduct it on the tax return, but it wasn't reported to the IRS on a Form 1099-B. And if you check off F, that means there was no 1099-B issued by the broker that was given to the IRS. And at the bottom, again, you would just total up the whole page, and then it's reported again back on Schedule D on its proper line, yeah? In the case of long term, either DEF. Again, here's that Schedule D. Yeah. the ABC totals over here, and the DEF totals over here. Here's an example of a 1099B. I believe we had seen this in a previous video. Here's the description of what was sold, the date the taxpayer purchased the property, the date that was sold. That will determine whether the gain or loss is going to be long or short term. Here's the sales price. Again, probably already subtracting out the selling expenses. And here's the cost basis that may or may not be reported to the IRS. So how do you know it was reported or not? Just because it's here doesn't mean it was reported to the IRS. You got to take a look at this box down here in line 12, box 12. And if it's checked off, that means it's that situation A or D. Let's go back again here. 8949. A or D, meaning that it was showing the cost basis going to the IRS. Yeah, this is long term. And A would also be cost basis reported to the IRS. Okay, so this is a 1099B form that was being referenced in the previous forms. Let's go back to Schedule D. So we enter all the profits here for the different categorizations, in this case for short term, and then we subtract out, remember, any unused losses being carried over from previous years, and this is just for short term. You notice the brackets are already to subtract out to get a net short-term gain or loss. And then in the long-term section, again, we add up all the different categories of DEF. And let's see, here is a carryover of long-term losses from a previous year. Let me point out this line 13 here, something called not net capital gains, but capital gain distributions coming from a mutual fund or exchange traded fund. Let's take a look at this Sched 1099 DIV form. So we've seen this form back in chapter 3 where we reported ordinary and qualified dividends. But also, again, if this may be coming from a mutual fund company, they may be buying and selling investments, incurring gains and losses. And the net gain allocated to our taxpayer here is not treated as a dividend, but is treated as a capital gain distribution. And the default is long term. So whatever figure you see here in box 2A is going to be reported on Schedule D here in this line 13 and added up with the other long-term capital gains. So here at the bottom we take a net long-term capital gain or loss. So just like we've seen in the previous videos, we net out the short-term. Here's the net short-term gain or loss. And here at the bottom of the first page is a net long-term gain or loss. So those two figures, you combine them together to get a total. And they don't even name the total here because it may not be possibly relevant. But if it ends up with a gain here, that gain is reported back on the 1040 form, that line 6. The 1040 form here in line 6. And again, if it's a loss, not a gain here, you have to go down here and limit the loss up to $3,000 for married filing joint, or $1,500 if it's a married filing separate return. And again, any excess unused losses you carry over to next year's Schedule D and deduct it over here for long term, or deduct it over here for short term. There's some other information back here on the page 2 of the Schedule D saying that you may have to go to a worksheet to figure out the tax. Here's something called qualified dividends that we learned back in chapter 3. that get taxed at low rates. The same low rates we're learning now here in Chapter 11 for net capital gains. Okay, again, it's referencing this worksheet that's in the instructions to the 1040 form. Worksheets are typically not filed with the tax return. You just keep it here, this worksheet, for your own records. So it starts off here in line 1 with this line 11B coming from the 1040 form. This is the taxable income line on the 1040 form that includes the net capital gains and also qualified dividends. But because those two items are taxed at lower rates, we got to back out here qualified dividends. That's coming from line 3A of the 1040. And then also backing out a net long-term capital gain, which may not be the amount on the 1040 form. So you got to go back to the Schedule D and figure out if there is a net capital gain amount that we put here. And we're going to back those amounts out from the taxable income to figure out if we exceed, the remainder exceeds a certain limit. So if you see these large dollar amounts here and down here, so in the case of a single filing status taxpayer, if their taxable income, that's this line 1 up here that includes the qualified dividends and capital gains, if their taxable income is less than this $39,375, that means the qualified dividends and net capital gains get taxed at this amount here. In other words, tax-free. And if your taxable income for a single filing status exceeds this large amount, that means their net capital gains and qualified dividends get taxed at this higher amount, which is still less than the regular income tax rate, but for wealthier taxpayers, they get taxed at 20%. And if the taxable income based upon the filing statuses fall in between the two amounts here, okay, line 8 and line 15, that means their qualified dividends and capital gain, net capital gains get taxed at this 15% rate, which most taxpayers qualify for. Again, they probably make more than this taxable income, but definitely less than this. Those two preferred types of income get taxed at this relatively low 15%. And then the rest of their income, here in line 24, gets taxed at the regular rates. And we saw before back in chapter 2, if the taxable income was under 100,000, we used the tax tables. And if it was 100,000 or more, we used the tax rate schedule, here called the tax computation worksheet. So we add up the taxes on this other income, we add up the taxes on their preferred income of 0, 15, or 20%, and down here at the very bottom would be the total income tax for the year that we take back to the 1040 form, and here write it in on page 2, line 12A. Let's talk about one more tax, not income tax, but a tax for people that are relatively wealthy that have this net capital gains and investment income. I believe we had briefly talked about this form called 8960, the net investment income tax, not regular income tax, yeah, but tax on the taxpayers' investments, things like interest income, dividend income, some not retirement income, but annuities that was discussed in chapter 3. Here you're a landlord that we're going to learn about in next semester's Accounting 137 class, or a partner in a partnership, or a shareholder in an S corporation, or beneficiary of a trust, probably what we call passive income. But we also learned about another type of investment income here in chapter 11 called capital gains. So all of this type of income is going to be taxed again um, under this net investment tax that was created a few years ago to help fund the Affordable Care Act, or that Obamacare health insurance. And the rate is, well, you're going to be subject to the tax if your modified adjusted gross income exceeds probably either 200,000 or 250,000, depending upon the filing status. And any excess or the net investment income we calculated at the top of this form is going to be taxed at a rate of 3.8%. So that tax will show up on a Schedule 2 and added to the income tax. Yeah, so if you're paying that tax, that means you're probably wealthy, you have good investments, your income is high. Okay, that's it for Chapter 11. We've just gone through the tax form schedules and worksheets to figure out the preferred tax rate on certain types of investments. Make sure you read the chapter. I believe I say somewhere that don't read the whole chapter. Read from page 1 through page 17 in chapter 11. And the rest of the topics in that chapter we'll be covering next semester, the so-called business taxation.